Welcome to the Credit Clubhouse, covering all things credit all the time. I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Before we jump into our first episode, I just wanted to provide a little more context to this new effort. For those who might not be familiar with Deal Catalyst is redefining how the finance industry connects, collaborates, and drives meaningful transactions. We're more than just an event organizer. We're disruptors, innovators, and facilitators. So with that in mind, we've created this new platform to engage the credit community and also have some fun while doing it. Stay tuned. We're going to have interviews with market leaders, fresh takes on the news, live shows, and much, much more. This platform is all about community, capital, and connections. We hope you join us for the ride. Now on to our first episode. I was joined by Amanda Lynam, Head of Macro Credit Research at BlackRock. Amanda discusses the latest macro credit news, including 2 recent Fed meetings, tariffs, inflation, the continued growth of private credit, and some structural changes that have taken place the last couple of years. Without further ado, I present my conversation with Amanda Lynam of BlackRock. I hope you enjoy the show. Welcome to the podcast, Amanda. How are you?
I'm great, Todd. Thank you for having me.
Well, thanks again for joining me. I'd like to kick off the conversation just with a little bit of background. Tell us a little bit about yourself. What's your current role, and how did you ultimately come to work at BlackRock?
Yeah, sure. So thanks again. So Amanda Lynam, I'm the head of macro credit research here at BlackRock within our portfolio management group. I joined BlackRock a little over 2 years ago. Prior to that, I was at Goldman Sachs for many years. I would say the short version of my career is that I've spent the entirety of it, except for a brief period in public accounting, focused on the corporate credit markets, but I've done a variety of things. I've covered companies as a sector analyst for many years. I covered insurance and healthcare. I worked in institutional credit sales for a bit. And then for the last several years, I've been in more of a macro-facing seat as a global credit strategist. So at Goldman, I was responsible for views across IG, high yield, leverage loans, private debt. Similar here at BlackRock, responsible for the same sort of mandate, I would say, plus commercial real estate. And it's a fun job, and there's always something exciting going on.
So we're a couple of months into the new year. I'd say going into the year, having conversations with a lot of different market participants, there was certainly a lot of excitement going into the new year, given the new administration, their at least signals that there'll be less of a regulatory burden, though there's also other uncertainties with tariffs and inflation kind of not fully going away. Was there too much excitement going into the year now that we're a couple of months into it? Is some of it warranted? Kind of what's your initial thoughts on kind of where we're at a couple of months into the year and obviously, 6-7 weeks into the new administration?
Sure. So I would say the way that we've characterized the strength really in risk assets across the corporate credit market is warranted resilience. And that's largely been a function of a growth backdrop that is above trend. And at the end of the day, it's really the growth backdrop that we view as one of the most critical inputs into corporate credit valuations. I think perhaps one of the most surprising aspects of the corporate credit market to a lot of market participants has just been the strength of the technical backdrop as well in corporate credit. So you have a supportive growth backdrop with above trend economic activity coupled with limited new money in areas like leveraged finance, where a lot of the supply is refinancing related. You have a really strong yield-based bid from investors who are almost looking past tight spread levels and are investing instead on the income opportunity in corporate credit. And then on top of all of that, you mentioned there's kind of just a lot of optimism, and I would characterize it as kind of like animal spirits in the market looking ahead. So I think I don't believe that really it's a function of solely the policy outlook environment. I think there are actually some real fundamental and technical drivers that were in place, by the way, in 2024 that contributed to a pretty significant tightening in corporate credit spreads that are with us in 2025. Looking ahead, I would say emphasize really two things. One is the growth backdrop will remain critical to corporates' ability to navigate this landscape. The interest rate environment is actually still quite elevated as we are recording this relative to where I think market pricing would have had it if we were having this conversation a couple of quarters ago. And so what that means is that corporates will still need to navigate what is a structurally higher cost of capital. Now, again, if growth is supportive and the reason for those higher rates is growth related, that is a backdrop that can be, in our view, easily digested by corporate credit. If, on the other hand, rates are higher because of inflation expectations and growth is slowing, that is not a great combination for corporate credit. So that will be, I think, first and foremost to watch over the next few quarters is, does that growth momentum that has so far been above trend and has been that case really for the past several quarters, does that persist? The other element that we are really expecting is this idea of dispersion. And so one of our real themes that we've been emphasizing over the past few quarters has been dispersion, but not widespread market disruption. And you see that in a variety of different ways. You see that in the bifurcation amongst the consumer. You see it in the commercial real estate market, even within categories within commercial real estate. You see it in corporate credit. That's a trend that we expect to persist also going forward, influenced by some of the policies that you mentioned. Importantly, though, I think what the advice that we're giving our clients is that we really need to build portfolios that can withstand a wide range of growth and inflation scenarios. So that includes incorporating floating rate exposures, real assets as inflation hedges, different points on the quality spectrum, different parts on the curve. And so it's really a kind of a holistic approach to navigating what is undoubtedly uncertainty that will create volatility. Oftentimes that creates opportunities for investors. But I think navigating it in a smart way that really, of all the tools in your toolkit to really navigate that period is what will be really important for us.
What would you say, I guess, starting off the year, and has there been a shift to kind of what you see as kind of could be some of the biggest impediments? Is it the tariffs that, it seems the new administration has, kind of at least threatened and then pulled back on some, but, has certainly his appetite to make sure that he's using that as one of his tools in the toolkit. Are there any other impediments that you see? Obviously, we've had a couple of recent Fed meetings. Has there been any surprises out of those that would, I guess, signal some potential red flags?
Sure. I think one of the surprises that we've seen coming out to start this year has been the strength in Europe, frankly. So you've seen European credit actually hold in really well versus U.S. credit. You've seen European equities do well. That, I think, has been a bit of a surprise. As it relates to the policy impact, we're trying to really look at this holistically. So we're not looking at, for example, tariffs in isolation, but rather kind of the whole set of policy proposals, including potential for tax cuts, potential for deregulation, changes in tariff policy, trade policy, all of that we're watching in totality, right? Because there will be different puts and takes through the economy. But I think it was expected that just the idea of trade policy uncertainty could have weighed more on an export-oriented economy like Europe. And so far, we haven't really seen that show up in risk asset performance. So I would put that squarely in the bucket of positive surprises to the upside so far this year. And I think it will remain to be seen whether or not that can persist. Again, going back to the technicals point that I mentioned at the start, there and warranted resilience, there are actual real fundamental reasons why Europe is holding in better. For example, actually the high yield market in Europe tends to skew a bit higher in ratings than its U.S. peer. The ECB still owns a portion of the European investment grade market, for example. So that's been kind of a technical tailwind. European corporate credit is also just a smaller market relative to the U.S. So there are fewer bonds to go around. That's also a technical support factor. So when you dig into the nuances of some of this performance, you can kind of explain why some of this resilience is happening. But I think all else being equal, an increase in trade policy uncertainty could have had the potential to weigh more heavily on Europe, and we haven't seen that. I think what that tells you is that if you are going to express a view on, say, growth differentials across regions or interest rate differentials or the impact of trade policy, probably corporate credit isn't the best way to express that. Perhaps it's more appropriate in a macro type product, maybe like FX, for example, that would reflect those differences a bit more clearly. But that I would put that in the camp of surprising to the upside. I think I wouldn't say this was a surprise, but I think also the Fed has moved more in line with the messaging to start the year as well, that they are not in a rush to cut rates. And so I think we're pretty confident that while there is possibility for another rate cut this cycle, it's probably not going to materialize in our view in the first half of 2025. So we do expect a bit of a pause from the Fed. As you alluded at the start, inflation is above trend. As I discussed earlier, growth is above trend. The labor market has rebalanced, but it remains quite solid. So it's not obvious to us that there's a real urgent need for the Fed to cut rates swiftly in the near term. We've always been expecting a bit of a normalizing monetary policy cycle, not an easing cycle. So we were already expecting the rate cuts to be quite shallow. But I think the Fed in recent weeks, including at the January FOMC and also in Chair Powell's congressional testimony, just reiterated the point that they're not in a hurry to cut rates. I think if we do see a rate cut, it's really going to be driven by deterioration in the labor market. So that's why we've stopped short of saying something along the lines that there will be no rate cuts this year, because I don't think we can see that far in advance into how the labor market might evolve. But I do think that we need to be in an environment bracing for corporates to navigate a higher cost of capital. And again, that speaks to the point of dispersion, but not disruption, really making sure that you have all sorts of tools in your toolkit. And actually floating rate assets have been an important, I would say, diversifier in portfolios, because even though the Fed has cut rates by 100 basis points, long end treasury yields have sold off since that time, since the Fed started cutting rates. And so that has been a headwind in some ways to long duration fixed income. So it's important to have those balancing factors of some floating rate exposure, some short duration in portfolios in our view.
So one of the shifting gears a little bit, one of obviously the hottest terms of the last few years has been private credit. In your estimation, kind of what you see and how you view the market, do you see the continued growth in private credit? I mean, we see it at our events, direct lending, ABF, SRT, amongst many, many other strategies, that clearly there seems to be plenty of opportunities for private credit to go into all these different areas in the markets. Is that trajectory kind of still in your minds, where it just won't wane over the next few years? And ultimately, is there enough demand in the market over the next few years to take all this influx of new capital?
Yeah. Sure. Yeah. So maybe I'll start by saying, yes, we absolutely do see scope for further growth and momentum in the private credit asset class. I would first start by saying that the definition of private credit appears to be evolving. And I would say the catalyst for that was really the regional banking disruption in March of 2023, which showed us that some of the asset liability mismatches in the banking system, for example, banks often lend long, but actually borrow short or use short-term customer deposits to make those loans, may result in some loans being better suited to live outside of the banking system. So they may be originated in the banking system, but perhaps they live outside of the banking system. And I think that regional banking disruption in 2023 really showed the benefit from a financial stability perspective of having a long-term viable funding source like private credit that can coexist peacefully, in our view, alongside the banking sector and alongside the public debt and equity markets. And so I think as private credit has grown into a sizable, scalable asset class, it can now service areas where it previously couldn't, like larger companies. It can actually service companies that have demonstrated access to the public debt markets. And it's really no longer reserved for niche financing situations. So I think that expansion of private credit, coupled with the regional banking disruption in 2023, has caused market participants to really capture anything that can be originated, structured, and held by a lender as private credit. So if we were having this conversation 2 years ago and we were talking about private credit, we'd really just be talking about directly negotiated middle market lending. Now we're talking about lending to IG corporates. We're talking about private asset-based finance. We're talking about a wider range of opportunities. So I absolutely see scope for that growth momentum and that expansion of that addressable market of borrowers and investors to continue. I would say on the growth point, the reason that we are so confident in the growth of private credit is that the growth drivers, in our view, are multifaceted. So we're not relying on any one segment of the market or any one theme to really carry that through. So to level set, we have a forecast of $4.5 trillion by 2030. So that would represent around a 15% compound annual growth rate in global private credit AUM industry wide by our definitions. And that would actually be below the compound annual growth rate of the past 5 years, slightly. So I would say ongoing momentum, but moderating and I think realistic, but still quite sizable. There's a lot of room for growth, though, when you think about that $4.5 trillion relative, for example, the size of loans on U.S. bank and European bank balance sheets, the size of the corporate credit markets globally, especially in the U.S. Right. So $4.5 trillion sounds large, but it's actually small in the grand scheme of the financing ecosystem. The four multifaceted drivers that I mentioned are investors' desire for diversification, income, and I would add to that increased comfort with the asset class, kind of as the track record has extended. The second point is borrowers' desire for certainty of execution, especially, for example, if they're funding multi-phase large capex programs or M&A, especially if and when markets become choppy again, that value, that certainty of execution is really important for borrowers. The third factor, which I don't think is actually discussed enough, is the structural changes in the public debt and equity markets. So, for example, public debt markets are serving larger and larger borrowers. For a middle market company that just needs maybe 100 or 150 million in financing, the public debt market may not be where they get the best execution. They run the risk of the debt issue trading poorly, being illiquid, poorly held, may not just be big enough to be liquid in the public debt markets. And so that's a real consideration that corporates need to think about. Which may not have been the case several years ago. And then also on the equity side, companies are staying private for longer. So when you think about being able as an investor to participate earlier in the growth journey of a company, private markets are a way to do that. And you can really participate in that growth before that company is ready to enter the public markets. And then the fourth is ongoing selectivity in bank lending. So bank lending standards have tightened, although I would say we're off the peaks that we experienced just after the regional banking disruption. Nonetheless, banks are being selective with how they use their capital, and I think that's appropriate. And as I mentioned earlier, there's a role for kind of private markets to complement the financing that's available from banks and from the public debt and equity markets. And we think on net, that's a positive for financial stability. So we do see a lot of room to run, both as the addressable market of investors and borrowers expands, as the private credit definition evolves. But I think importantly, even within kind of the traditional asset class of say, direct lending in North America, there's still a lot of scope for that asset class to grow, because when you look at, say, investor participation and average target allocations, which are tracked by Preqin, for example, private credit is actually still smaller than what you see in private equity and real estate. So there's room for investor participation in private credit to expand relative to private equity and real estate. And then also of those investors that participate, there's room for them to have higher target allocations. So we kind of see growth all around. And then not even included in what I mentioned is the potential growth opportunity from expansion into retail and expansion further within the insurance sectors. And so those are two really powerful markets that could benefit because they are typically longer term investors, especially when you think about family offices, high net worth individuals. They don't need all the funds that they're in their investment accounts to be liquid all the time, or at least they don't need all of it to be liquid all the time. They can really benefit from having that kind of uncorrelated exposure, that income generation and diversification from private markets.
The the size of the market. I mean, is there kind of a consensus on that definition? Because I've heard numbers as high as 40 trillion.
Yeah.
I heard recently someone say it's 20 trillion right now in terms of the ABF market, and private credit obviously is a large segment of that. I mean, is there a kind of a consensus among the market, or is, as you said at the beginning of that answer, kind of it's still evolving, and maybe what one, house might say, what it is today versus another? I mean, it seems like there's still a bit of an evolution in the definition.
Sure. So I think probably one of the points that I would note is that there's a difference between the addressable market. So what is the potential market opportunity, which I would say skews towards those much higher figures that you mentioned, versus what is actually private credit AUM invested today. Just to level set, we use the universe of Preqin, and then we add on BDCs to that, which are tracked by Cliffwater. You get to around a figure of around 2 trillion today. And we expect that to grow to 4.5 trillion by 2030. So that's kind of how we level set. When you think about some of the larger numbers that are floated out there, you are really talking about potential for expansion and what that addressable market is. And so private ABF, as you mentioned, is a great example. That includes really large securitized markets that are either on bank balance sheets or it's securitized elsewhere. And is there scope for private credit as a long-term provider of capital to finance those markets? Yes, absolutely. We think that there is. And so I think that's probably where maybe some of the differential is between private credit AUM today, and what that growth prospect is, and then what is actually the addressable market? What is the universe that could potentially tap this financing, but needs to decide whether or not to do that?
And in terms of the location of a lot of this, I mean, I it's certainly predominantly U.S. today, but are you seeing some of the same growth in Europe, Asia, the Middle East?
Yep.
Kind of what does it look like beyond just the U.S. borders? Obviously, the U.S. is clearly the biggest.
Sure. Yes. So as you mentioned, North America does represent the bulk of private credit AUM. That's again using the Preqin figures, but I think importantly, there's a lot of scope for growth outside of North America for the simple reason that a lot of the regions outside North America, like Europe and Asia, are currently more reliant on bank financing to fund and finance their overall economic activity. And so we see a power of kind of diversifying the financing sources around that. Look no further, for example, than in Europe, where there's been a lot of focus from President Lagarde and other, I would say, officials in the region to really emphasize the importance of a capital markets union in Europe, for example. And so that is, I think, a trend that has a lot more room to run, is that as these economies diversify their funding sources, alongside the bank financing, which for sure will remain at the center of the financing ecosystem, but allowing kind of private markets to, say, fund early stage companies, participate in those growth journeys earlier, perhaps boost productivity in regions like Europe, for example. We think that's going to be really important. And so we do see scope for growth outside of North America. But to be very clear, the North American market is not saturated at this point. Private credit is largest in North America. But again, when you think about the size of the universe relative to bank balance sheets, even just the U.S. corporate credit market, which is the broadest and deepest market really globally, there's a lot of room to run in terms of the financing needs when you think about just longer term structural shifts, corporate balance sheets, many of whom may have saturated corporate debt markets in some ways, and when might they turn to private financing. So I think there's still a lot of room to grow in North America, which is the largest market, but then for sure expand regionally as diversification and funding sources gets more momentum.
Are some of the structural changes with banks, are some of those same changes happening around the globe, or is some of that unique to the U.S.? Obviously, given the banking crisis of 2023, but you're also seeing other things happen in the banking market. I don't know what's going to happen with ultimately the Basel and how that might impact markets like SRT, but are some of the same drivers that have maybe helped fuel some of the private credit growth here? Do you see some of that elsewhere, or is some of that unique to the U.S.?
Well, I do think I do think probably one of the standout features of this cycle has been the higher productivity in the US economy relative to some regions like Europe that's been well documented. And I think one of the ways that perhaps European productivity can be boosted is to kind of finance that innovation earlier. And so I do think that's a focus. You see that, for example, Mario Draghi's report on productivity in Europe had gained a lot of momentum a couple of months ago. I think there is a big push to see how that market can be financed in terms of innovation earlier. So I do think that there was maybe perhaps a lesson learned from the U.S. economic patterns into other regions like Europe. As for the banking system, Europe is, as you know, much more fragmented by country. And so it's not, for example, an apples to apples comparison, but I would say that the US has led in some ways in terms of expanding beyond the banking system to financing among private markets. And I do think when you can look at the Bank for International Settlements, the data that shows, for example, the reliance on the bank lending channel to finance the overall economy. Other regions rely much more on the banking channel than the U.S. does to finance overall economic activity. I think that's probably a trend where those regions may move closer in the direction of the U.S. Not to say that they will close the gap completely, but I do think there are some lessons learned into the benefits of actually having private markets finance innovation and fund companies earlier in their growth cycles that I think could be applicable in those regions for sure.
The public-private debate, companies staying private for longer, obviously the growth of private credit more widely. I mean, do you see some of the changes that have occurred that have maybe forced some of those shifts in the market? Do you see some of that evolving or changing over time where companies go public more often than they are today? Do you see kind of a resurgence maybe of what the public markets were, or do you see some of these structural changes long term, kind of taking hold?
Sure. I mean, I think a lot of this is dependent upon market conditions, I would say, first and foremost. And so we've seen, even just over the past 2 or 3 years, conditions where, say, the public debt markets were effectively closed to lower rated borrowers. And then we've pivoted to an era like we're in today, where the markets are, frankly, quite wide open to a wide range of borrowers. And so some of this is subject to market conditions. Similar in the equity IPO market, there was a robust period of IPO activity a few years ago, and then we've had more of a lull. We are, as a baseline, expecting more of an uptick in broader capital markets activity. I think for sure that includes strategic M&A transactions, but where there's really room to catch up is on the sponsor related side. If you actually look at strategic M&A, so acquisitions between corporates, buying and selling, that's actually not that far below the 10-year trend if you use data from Dealogic, but sponsor related M&A has been quite lagging. And it makes sense because financing costs are just such a massive input into the economics of a sponsor-related transaction that the higher cost of capital had sidelined things for a bit. We do think that will start to open up. I think it won't be, though, a kind of a robust watershed of activity. I think it's going to be a gradual recovery fueled by a few things. One, increased confidence that we've avoided a hard landing. Two, acceptance of a higher rate environment. And I think just general, increased focus on kind of returning value, for example, in private equity to LPs, because actually inventories are becoming quite aged because of the lower exits in recent quarters. That being said, there will be some dispersion around vintages, and I think perhaps there are some transactions that still need to improve their multiples before they kind of attempt an exit. And so that's why we're expecting more of a gradual uptick. Does it change, and kind of do we revert back to a pattern where companies are going public earlier? It's a good question. I would say there's just been a longer term structural shift of companies staying private for longer that predated the regional banking disruption in 2023, really. And you can see that clearly by the number of listed companies in the US, for example, on the NASDAQ and NYSE. I guess the question will be, is it critical for a company's business model to be in the public domain, or can they get the financing that they need while they're in this stage of their growth journey, even if it's a later stage growth journey, from the private markets? I think that it is a benefit that the private markets have been able to service even larger borrowers in this environment, again, because it's grown into this sizable, scalable asset class that can fund larger deals. I think, again, that's a net positive for financial stability. I think I don't see that trend really changing. And I think what's probably even more notable is that private credit isn't exclusively reserved for non-listed companies, right? We have seen examples of companies that either have private or that have public debt outstanding and they've refinanced it with private credit, or alternatively, they've added private financing alongside public debt in their capital structure because they're issuing at a different subsidiary, or they've saturated the public debt markets in a certain region and they kind of want more creative, bespoke financing for a longer term need. They don't want to be tapping the debt markets year after year for, say, a long-term project. So I actually think this trend is here to stay. And maybe it's somewhat related to your question earlier on kind of the interaction with the banking channel. Again, I think they coexist peacefully, right? I think there's a benefit actually to what has been seemingly a new wave of bank partnerships with asset managers, where maybe the bank originates a loan and that loan doesn't have to live on the bank balance sheet. It can actually live in the non-banking system, but then the bank still maintains the customer coverage relationship. Maybe they service the customer for other needs. And actually, I think that's a net positive from the financial stability point.
It seems that it's just infused this flexibility into the system that allows banks maybe a little bit more flexibility than if everything was just sitting on their balance sheets. Working with asset managers, partnering with different capital sources allows them to be more flexible at the same time.
I think that's right. And I actually think, I started at the top talking about my time covering insurance. I kind of think of it as how the insurance industry utilizes reinsurance, right? Like they write long-term business. Sometimes that business is meant to live on their books for years at a time. They may want to make changes to that business mix, or they may, need capital relief in some instances. So they will use the reinsurance industry to provide that so that they can still be in the market providing insurance and writing insurance for clients. I view it very similarly. Obviously, there are differences between the two sectors, but I think this is just kind of a natural evolution of the private credit market, just like the insurance industry uses reinsurers, and not to complicate it, but reinsurers use retrocession insurance, right? So there are different layers to all of this, and I don't think private credit is really any different than that.
So we have just a couple of minutes left. I like to end a little bit lighter and more fun. So do you have a favorite sports team or favorite hobby?
Well, I've got two. So I'm from Pittsburgh, so I'm obligated to be a Pittsburgh Steelers fan. And then also we are heading into college basketball season, so I would be remiss if I did not mention my Villanova Wildcats. So big Villanova supporter. Yeah.
Tell us one surprising thing about yourself.
Let's see. I would say maybe the surprising thing about myself, I'm very supportive of animal rescue, and I've rescued a couple senior boxers, which for those who know boxers, they're kind of big dogs with a smooshed face. Probably not the dog that maybe you would think that I would have, but I'm a massive advocate for animal rescue and especially the senior boxers. Yeah.
The most exciting part of your job?
I would say I love the macro focus of my job, having covered companies for a long time, and really focused on the nuances of a sector analyst. Now being in the macro world for the past several years, I would say it's a really exciting kind of front row seat to anything that's going on across the globe. Really, there's literally never a dull moment. And I do think that probably one of the favorite parts of my job is marrying the micro with the macro. And so what I mean by that is kind of being able to, having covered companies for so long, understand how shifts in sentiment amongst kind of large names, whether that's in the equity market or the credit market, can really impact the tone more broadly across an asset class. And I think in periods like this, where there's a heightened amount of uncertainty and policy volatility, paying attention to those micro level trends, what those companies are saying, whether it's on supply chain disruptions or labor shortages or tariffs. I think that will be incredibly valuable going forward. And so I'm kind of looking forward to dusting off my skills to be able to look at a company transcript again and say, this is what we should be watching for. So.
And then final question, one prediction for the next 12 months.
I think actually this one, I think there's a lot of skepticism that the market can record 3 strong years in a row. And I would say I hear this a lot when we speak to equity investors, most notably that, we had a great year in 2023 in equities, in U.S. equities. We had another great year in 2024. Can it repeat in 2025? And I think if there is one surprise for 2025, I'm wondering if it's an upside risk, that the market is more resilient than we expected, perhaps on the equity side. Credit is more resilient than even we expected, and we've been bullish for some time on the spread market, as you know. But I actually, while there are certainly a lot of potholes to navigate and uncertainty, and we are expecting choppy volatility, I think we would be remiss if we didn't recognize that the risks are two-sided and that we could actually be surprised by upside in certain risk assets. And so that's something that we try to keep in mind. There was an opportunity cost to being too defensive in 2024. We saw that. Actually, the right trade was to move down in quality and credit, for example. And so we're mindful of upside risks in 2025.
Well, Amanda, I really appreciate you taking some time and chatting with me. So it was great to have you on the show, and hopefully we'll get you back sometime in the future.
It was my pleasure. Thanks for having me, Todd. Thank you.
Yep. Thank you.